Hello, my name is Kyle Rodda and welcome to this week's Investor Spotlight. In this week's video, we look at what happened last week in UK financial markets and how it might impact market sentiment locally with three stocks that have business connections to the United Kingdom. The UK economy has been plagued by high inflation due to a combination of supply and demand dynamics. On the supply side, the UK economy has been hit acutely by the war in Ukraine and the subsequent surge in energy prices. Inflation in the UK has hit as high as 10.1%, with many analysts predicting it could surge towards 20%. In an effort to ease cost of living pressures, the new UK Prime Minister, Liz Truss, announced a suite of measures in a mini budget, which included sweeping tax cuts. On aggregate, the budget fueled fears that it would add to already strong demand and put even greater pressure on inflation. UK gilts, or the country's government bonds, tumbled as market participants priced in higher inflation expectations, along with the necessary increase in the supply of bonds in the market to fund the additional spending. Yields rise as prices fall, so the move hit the value of these assets while also increasing the cost to service debt. The move in gilts was the largest in history. Due to the rapidity of the move, several UK pension funds, which paid out defined benefits to their members, found themselves in margin call because of the leverage they had on these positions. To stump up the cash required, these funds also sold other assets, like local and global equities, sparking a cascade effect in global markets. In order to stabilise the situation, the Bank of England quickly intervened, halting its planned quantitative tightening program or the selling back of the bonds it purchased during the pandemic, and promised to backstop the gilt market until it returned to normal market conditions. As investors dumped UK bonds, they also sold the pound, with nervous investors buying the US dollar in a search for relative safety. The pound also hit an all-time low, touching 103.82 briefly, before springing back as markets stabilised and confidence returned, however brief it may prove to be. Interestingly, the pound also fell considerably against the Australian dollar, despite the latter's propensity to depreciate in times of market turmoil. It fell briefly to levels not seen since Brexit, before bouncing to above where it was prior to the sell-off in gilts. Currently, key support is around 168.50, while key resistance is just above spot at 170.40. Given the turmoil in UK markets currently, the natural question to ask is how now a good time to invest in UK businesses. On the one hand, the profits of some of these companies might benefit from a fall in the exchange rate. On the other, the potential economic impact and volatility in markets could undermine the value of these companies. Here we look at three companies with ties to the UK. Janus Henderson Group is a global asset manager with a dual listing on the London Stock Exchange and ASX. It has assets under management of around or slightly below US $400 billion. The company's stock has been a major underperformer this year, owing to, in large part to the highly correlated drop in global asset markets in 2022. So big has the drop been in the company's share price, it has recently fallen out of the ASX 200 index. The stock is down over 46% year to date, but analysts are largely bearish on the outlook for the stock. It has a consensus sell rating amongst 8 surveyed analysts, with 5 offering that recommendation, 2 suggesting a hold and 1 a buy. Interestingly, the consensus price target remains above its current price at $34.95. The technicals, meanwhile, are looking very bearish. The stock is trending lower and last week broke a key level of support around $32.60. That level now acts as resistance, with the next level of support possibly around $28.85. Virgin Money UK is a dual-listed holding company of several finance businesses. It's a small to medium-sized company which derives most of its revenue via retail banking. With the lift in interest rates and risks to UK growth, Virgin Money stock has underperformed over the last 12 months. The risk of a credit squeeze and greater pressure on households from UK government policy has seen the company's shares take another leg lower too. Despite this, the broker community maintains a slightly bullish bias on Virgin Money stock, though it may yet still experience downgrades after last week's events. Of 4 analysts, 2 have buy ratings and 1 a hold, and 1 a sell with a price target of $3.34. The technicals look less favourable for Virgin Money UK shares. Momentum is skewed to the downside and the trend clearly lower. The Crucially, price has broken a key level of support at $2.20, with the next clear level of support around $1.85. Ramsay Health Care is an Australian-based company with a dual listing on the ASX and LSE. It owns and operates hospitals and healthcare clinics across the globe with significant business in both Australia and the UK, amongst other countries. Ramsay is one company that could benefit from the exchange rate impact on its profits. According to its full-year results recently, the company's revenues in the UK doubled to 1.2 billion Australian dollars last year. This was despite major disruptions caused by the pandemic, including staff shortages, higher operating costs, and inflationary pressures. Analysts are mixed towards Ramsay Healthcare stock, with the stock possessing a consensus hold rating currently. Of 17 analysts, 7 have a buy rating, 8 a hold and 2 a sell. The price action looks very ugly for Ramsay Healthcare shares. The company's full-year results sparked a considerable sell-off in its stock, pushing it to lows not seen since the start of the pandemic. Currently, price is resting on support at around $57.